In today's video, we're taking a look at a significant event in global financial history, the Chinese stock market crash of 2015. This crash shocked the world, with ripple effects across global markets. China, the world's second-largest economy, was facing a massive market sell-off. But what caused the crash? How did it unfold? And what were the global consequences? Let's dive in. The boom before the bust. The Chinese stock market experienced explosive growth in the years leading up to 2015. From 2014 to mid-2015, stock prices in China's Shanghai Composite Index soared, fueled by a massive influx of retail investors. The Chinese government had been encouraging citizens to invest in the stock market as a way to diversify wealth and increase economic activity. With rising wages, easy access to credit, and a booming economy, millions of Chinese people jumped into the stock market, driving prices to unsustainable heights. This rapid growth led to a classic asset bubble, where stock prices were detached from the real value of the companies they represented. But as we know, bubbles don't last forever. The initial signs of trouble as the stock market reached record highs in mid-2015, there were early signs of trouble. By June 2015, the market began to show signs of volatility. Stocks started to experience sharp declines, and the government started taking action. The Chinese government stepped in to try and stabilize the market. It halted initial public offerings, IPOs, restricted short selling, and encouraged state-backed funds to buy up stocks to prevent further declines. Despite these measures, the market continued to fall. The Shanghai Composite Index, which had gained more than 150% in just over a year, began to lose ground rapidly, falling by over 30% from its peak in June. The crash in full force. By July 2015, the Chinese stock market was in freefall. On July 8, the Shanghai Composite lost more than 5% of its value in a single day, triggering a wave of panic among investors. It wasn't just a minor dip, this was a full-blown crisis. By mid-July, the index had fallen by over 30%, wiping out trillions of dollars in market value. As stock prices plummeted, panic selling set in, with retail investors desperate to cut their losses. The government's attempts to prop up the market were not enough to reverse the downward trend. The Chinese government was faced with a difficult choice: continue to intervene or let the market find its own level. The consequences of both options were high, as the economic fallout would affect not just China, but the global economy. Causes of the crash. A perfect storm. So, what caused the Chinese stock market crash? It wasn't just one factor, it was a combination of several key issues. 1. Excessive speculation. Many retail investors were buying stocks without fully understanding the risks. 1. The market had become a speculative frenzy, where people were chasing quick profits rather than making informed investments. 2. High-margin trading. Many investors had bought stocks on margin, borrowing money to increase their exposure. 2. As stock prices fell, investors were forced to sell their holdings to cover their margin calls, leading to further declines in prices. 3. Government intervention. While the government tried to stabilize the market, some of their interventions backfired. 3. Measures like halting IPOs, restricting short selling, and encouraging state-run funds to buy stocks may have helped in the short term, but they also distorted market signals and contributed to a loss of confidence. 4. Economic slowdown. At the same time, China's economy was slowing down. 4. After years of rapid growth, GDP growth began to decelerate, and the country faced challenges like overcapacity in certain industries and rising debt levels. 4. The stock market crash was a symptom of broader concerns about the country's economic health. The aftermath. Economic and social impact. The crash had significant economic and social consequences for China. Millions of Chinese retail investors had invested their savings in the stock market, and the massive loss in value led to widespread financial hardship. Many families saw their wealth evaporate overnight, leading to growing public frustration. The Chinese economy, which was already facing a slowdown, felt the repercussions. The stock market turmoil spooked investors, and consumer confidence plummeted. It wasn't just a domestic issue, global markets were also affected. The Chinese stock market crash sent shockwaves through global markets, with major indices around the world experiencing sharp declines. For China, the crash raised questions about the sustainability of its economic model, which had relied heavily on debt-fueled growth and speculation. Government's response. More intervention. The Chinese government responded with further interventions to stabilize the economy. The People's Bank of China, PBOC, cut interest rates several times to stimulate borrowing and investment. The government also injected liquidity into the financial system to support banks and financial institutions. Despite these efforts, the market continued to struggle for months after the crash. The government's actions helped prevent an even worse outcome, but the road to recovery was long and uncertain. In addition to the immediate economic interventions, the crash led to greater scrutiny of China's financial system and its reliance on stock market speculation as a way to boost the economy. Long-term effects and reforms. In the years following the crash, China undertook a series of reforms aimed at preventing a similar crisis from happening again. The government implemented new measures to improve transparency in the stock market, strengthen regulations on margin trading, and limit excessive speculation. China also shifted its focus from a reliance on investment-driven growth to more sustainable models, emphasizing consumer spending and service-oriented industries. While the Chinese stock market has recovered from the crash, the event serves as a reminder of the dangers of rapid speculation and the importance of sound financial regulation. Global implications of the Chinese stock market crash. The Chinese stock market crash didn't just affect China, it had global consequences. China, as the world's second-largest economy, plays a critical role in the global financial system. The crash led to uncertainty in global markets, with many investors concerned about the health of the Chinese economy. Emerging markets, in particular, felt the pain, as China is a major trading partner for many countries. The crash affected everything from global commodity prices to the flow of capital into developing economies. To sum up, the Chinese stock market crash of 2015 was a turning point in global financial history. It highlighted the risks of speculative bubbles, the importance of government regulation, and the global interconnectedness of economies. While the crash caused significant pain for investors, it also served as a valuable lesson in the dangers of unchecked growth and excessive debt. What do you think about the 2015 Chinese stock market crash? Do you believe China has learned from the experience? Let us know in the comments. If you enjoyed this video, don't forget to like, subscribe, and hit the bell icon for more financial insights. Thanks for watching, and we'll see you in the next video.